Welcome viewers and thank you for joining us for the first installment of a four-part series entitled Future-Proofing the Graduate Professional. A special word of welcome to our members who are joining us today. So at PPS, we're all about graduate professionals. We are the largest mutual insurer in South Africa, and we exist solely to serve our professional members, who, unlike the clients of other insurers, are actually owners of our business, and they share in our profits. My name is Marlon, and I'm head of PPS Specialist Support Services. PPS Specialist Support Services provides technical advice and financial planning support to our supporting intermediaries and our members. Our session today is entitled Navigating Uncharted Territory. We are going to start with some market insights and commentary of both local and international markets. We will then look at the changing face of the digital landscape and how it's impacted our own offering at PPS. And then lastly, we're going to discuss some of the more unique benefits which our PPS members enjoy. So we're scheduled to run for about an hour today. We'll take about 40 minutes to get through the content. Thereafter, we're going to open up the floor to questions. Please note that all mics other than those of the co-presenters are switched off. Please use the chat function for all your questions and feel free to fire them as you go along at any time during the session. Please note, however, that we'll only address them during the allocated slot later on. Joining me today and representing PPS Investments, we have Haley Brown, Natalie Kiewit, and Luigi Marinas. Colleagues, please introduce yourselves to our viewers, starting with you, Haley.
Hello, everyone, and thanks so much for having us here today. My name is Haley Brown, and I head up the distribution and marketing team at PPS Investments. And hopefully today can share with you how PPS can help you and you as members and investors navigate these very turbulent times.
Thanks, Haley.
Hello, everyone. My name is Natalie Kiewit. I head up the PPS Investments operations team, which includes our client services team and our administration team. And I'm looking forward to sharing some about our digital engagement platforms with you.
Hi, everyone. I'm Luigi Marinas. I'm a portfolio manager at PPS Investments. I've been with PPS for about 7 years now, and I'm largely responsible for the more cautious funds in our product line. And I'll talk about some of the markets and what's happened in the world so far.
Okay, so thanks and welcome to you two colleagues. Luigi, we're going to start with you today. Looking at 2020, the year thus far, I think 2020 for most of us has been the very definition of VUCA. It's been a VUCA year on steroids. Market volatility is at levels that we've last seen during the financial crisis. And with so much uncertainty, both locally and abroad, it's difficult to foresee things returning back to normal anytime soon. Our president announced last month that government has proposed a risk-adjusted strategy as a blueprint for a return to normalcy. And just yesterday, I read in his latest address or speech, he made specific reference to the fact that as a nation and as a government, we have to heed the calls for a return back to normalcy. So that the plan seems pretty well thought out and sensible. In your opinion, has it inspired markets and business in general with confidence that a recovery is possibly on the way?
Yeah, thanks, Marlon. After a very difficult start to the year, I suppose that is what everyone is hoping for. Unfortunately, that's not really a question that can be answered in one step. So I prepared a few slides, and let's look at that to paint a picture of what has happened so far and what we could possibly be in store for going forward. So there's no doubt that 2020 has been a year of uncertainty thus far. Most countries across the world has experienced some form of lockdown, from the strict lockdown rules that we've seen in South Africa and in most of the European countries to some of the social distancing rules in Sweden and in Korea. This has definitely had a negative impact on many economic sectors, and even as lockdown rules are being relaxed in some countries, uncertainty still prevails. In South Africa, for example, we have so much confusion around whether we're in lockdown 4 now and what it means to be in lockdown 4. Are we going from level 4 to level 3, or can we go back to level 5? I agree with you that what the president said in his most recent letter does seem to point to a bit of more positivity in terms of having those levels come down a bit, and maybe we'll see some more introduction of certain things back into the economy. It's also meant that many people are working at home for the first time, and like all of us as well, becoming IT specialists as we go along. I'm sure some of the audience even has experienced some humorous incident on Teams or Zoom or Skype or whichever technology you use, like the example I have in the slide of the boss that turned herself into a potato during a meeting, only to realize that she couldn't turn the setting back. But peculiar incidents aside, though, it has also meant that the way in which we've always worked may change forever going forward. So let's look at 2020 from a markets perspective. What has happened? We know markets were fairly complacent leading up to the middle of February when the coronavirus was viewed as containable to Asia, but then fell sharply through to mid-March as it spread to Europe and the United States, and the threats of lockdown became a reality. But a lot of those markets have rebounded substantially post the announcement of significant monetary and fiscal support. We've seen large measures put into place by a lot of governments across the world. If we talk about the chart for a few seconds, SA property, the black line at the bottom, was already weakening prior to the sell-off and has fallen precipitously since then. Fortunately, we reduced the domestic property exposure in our portfolios to a maximum underweight in February. SA nominal bonds, which is the green line in the middle, and SA inflation bonds, the orange line, have both fallen sharply, but we've seen that they've rebounded and actually very close to the 100 level again, meaning they're close to parity in terms of the return again. SA equities, which is the green line, has fallen in lockstep with the USD returns of foreign equities, both in speed and in the level of the decline. Many investors haven't really realized that has happened in that way. The purple line, though, is global equity returns, but this time in rand terms. And so that's what we normally see. Of course, implicit in this is the currency that has depreciated materially. So we know that the rand has depreciated almost 25% against the dollar in the first quarter. So that means that even though global investments have performed well in rand terms, the real purchasing power of the rand has declined significantly. One of the questions that I get quite often is, have we seen this before? And this is quite an interesting chart, I think, to explain or to talk to that. This chart shows the performance of the SA equity market over the past 60 years. The blue line, which is a quite choppy line, is read off the left-hand axis and reflects the rolling 12-month price change in the index. You can see that it is very volatile. And why we say that investors in equities need a longer time horizon than just 12 months. The gray line, kind of in the light gray line in the background, is read off the right-hand axis, and it reflects why it's worth putting up with the short-term volatility. It charts the compounding effect of holding equities in real terms over time. If I look at the red circles now, there have been at least 8 or 9 previous significant market corrections over the past 60 years. But markets have typically rebounded smartly. And you can see of those lows where we see the red circles, how markets have bounced from that point. You can see the current correction on the far right, and already the market has rebounded somewhat in April. So the point, I think, on this chart is even though the blue line is very volatile, the gray line, which shows the total equity returns, still goes up over time. So is it the same this time? I suppose that's the very important question. And you can see the pink part of the chart is the forecast for the first quarter of 2020. Even though markets are resilient and equities generally perform well over time, it does not mean that risk can be ignored. GDP is forecast to decline significantly as economic activity has slowed, and I suppose there's no surprise there. And even though this chart shows an optimistic bounce back, that's not a given.
So, Luigi, what I'm hearing is that this correction has been quite severe. And I think now more than ever, diversification across asset classes, across regions, across industries, markets, even fund managers is critical. It also looks like we're going to need a bit of time to ride at this extreme volatility. Now, that has me thinking about the members in the audience and our viewers. In fact, the hundreds of millions of people possibly across the globe who are close to retirement. So my concern, I guess, is those that are facing retirement within the next 12 to 24 months, so we're talking the short to medium term, what does this mean for them? And how long do markets typically take to recover from a black swan type event like this? Do we have any data?
Yes, Marlon, that's a very important question, quite a good question. So let me start by addressing the question about how long it takes for markets to recover. From a slide that I just spoke about, and you can see the purple part, certain commentators and economists are forecasting an immediate bounce or a V-shaped recovery. Other possibilities are a U-shaped recovery where the bounce is not as sharp or quick and spread over a longer time. Then, of course, there's the dreaded L-shaped recovery that we saw in the Great Depression in the US in the 1930s, which is a possibility as well. This is where GDP declines, kind of stays at that level for a number of years and then recovers. Our concern is that even if lockdowns are ended, other questions still remain, like how long will it take for things to resemble what was or what used to be regarded as normal? When will people travel again? When will we see restaurants booked out again? And this leads us to believe that a U-shaped recovery is the most likely scenario. So this then speaks to the other part of your question about those planning to retire. We believe at the moment a more conservative approach is required, and that's how we've positioned our portfolios. We're definitely not saying, though, that everything or all clients' assets must be put into cash. You want to be cautious, but have enough risky assets in your portfolio so that you can participate should markets experience the V-shaped recovery. But all investors have specific needs and need their investments to address those needs. Yeah, did that answer your question, Marlon?
Luigi, so yes, sorry. I guess there's no real easy answer. There's not for me and certainly not for our audience. Doesn't look like there's a one-size-fits-all approach that we can adopt. And I think now certainly not the time to panic or to make any brash decisions. This Saturday, I found myself at the tail end of a snaking queue, a long queue up to the entrance of one of our local Woolworths. And as I was stuck in the queue, my eyes skimmed past all the closed shop fronts. And I couldn't help but think about the millions, if not billions, of people that are being affected financially by the crisis. The situation, the current situation is not sustainable. I found myself considering, the choice that our government faces. Is it really a binary one? Are we having to choose between the lesser of two evils? Do we really have to choose between asphyxiation or starvation?
there's no doubt that is probably the difficult decision that the government is faced with. And the chart above, or the chart that you can see on the screen, now talks a bit to that. The chart shows the amount of deaths due to various causes per week across the globe. COVID-19 is the blue line that you can see. And in just a matter of months, it has become the second biggest cause of deaths. So there is justification in trying to stop the spread of the disease. On the other hand, though, if we look at this chart, for how long can economies withstand being locked down? This chart shows the potential effect on GDP for various countries. And some of the numbers are quite scary. Look at the last one, it's Greece down 35% in terms of GDP. It shows the likelihood of deep recessions if lockdowns are not ended. So we believe that the measured approach of going through the different levels is appropriate to start economic activity going again. We do, however, believe that regular updates should be provided to the public, and we should not stall at a certain level for too long. If we have not moved levels within a strict time frame, the specific reasons should be made public, so that there's transparency in the plans and citizens can understand. We also mustn't forget that the government has made 500 billion rand available to provide for those worst affected in the lockdown. Of course, efficiency in distribution of this to the public is a very important consideration, though. And then economically speaking, what are some of the knock-on effects? We do not, most countries across the world have provided fiscal stimulus of up to 10% of GDP, like the US and South Africa. So 10% of GDP for South Africa was the 500 billion rand. From the US perspective, that 10% was $2 trillion that the US has made available. But in relative terms, it's on par with what some of the strongest nations in the world has done. The difference, though, is that in South Africa, the yield or the interest rate that we need to pay back on all this borrowing has increased. This is as a result of our emerging market status, as all emerging market debt suffered in the first quarter, and also in part due to being downgraded by Moody's as well. So where the US pays back debt at around 1% at the moment per annum, South Africa is paying back debt at greater than 10% per annum at the moment. So the obvious question is what happens to that debt after lockdown, and as you can see from the cartoon on the chart, it suggests that it does mean that our debt to GDP ratio is going to continue to increase and will become a greater consideration in future budgets.
Rudy, the situation seems dire. And I echo your concerns, and I think not just me, but pretty much every South African citizen has real concerns around South Africa as a nation, as a sovereign, to service that debt, given the cost of credit for us as a country. With that said, Winston Churchill famously once said during World War II, I think it was, that we should never ever waste a good crisis. Yeah. Are there any opportunities in the markets for investors in the midst of this crisis?
I would say yes, definitely, Marlon. There are opportunities. Basically, all asset classes have experienced a drawdown in the first quarter, like we showed on those initial charts. And looking forward, lots of asset classes look compelling on valuation grounds. The key, though, is not to be too enthusiastic and forget about the risks altogether. So let's consider a few asset classes. And I've decided to especially look at the ones that we tend to get more questions about. So let's talk about currency. It's a very common question. We always get asked what we think about the rand. The rand is probably the most volatile currency in the world because it's an emerging market currency and it's liquid. So by liquid, we mean people can trade it almost anywhere in the world. This means that it's almost impossible to forecast, especially in the short term. We prefer to take a longer term currency view by having a stable offshore allocation that's appropriate for a specific risk category. What we can say though, and if you look at the chart there, is that relative to other countries, South Africa is still one of the cheapest places to buy a beer whenever we'll be allowed to buy beer again. Okay, what about gold? This is actually my dad's favorite topic to talk about. He loves talking about gold, so I talk about it quite often. Although the chart, as you can see, shows some volatility in the gold price, this was actually quite stable compared to a lot of other asset classes. Gold does serve as an inflation hedge as well, and may play a small role in a well-diversified portfolio. But remember, gold does not pay interest or a dividend. So when you buy gold on investment grounds, you're simply hoping that someone in the future would be willing to pay more for the gold than what you pay for it now. So it's a very different consideration to buying a stock in a company that can grow earnings over time and pay dividends. What about property? It's another popular point of discussion. And the question is always, do we think it's time to buy a house now? So from an investment perspective, there's a difference between buying a house you're planning to live in and buying listed property on the stock exchange. Listed property is an investment in the company that owns and possibly manages property used for various things like office space, retail space, living space, and so forth. The decline in listed property prices was due to the expectation by the market that the lockdown in South Africa would mean it would be unlikely that these companies would collect the rent that was due to them. And we've seen many examples of that. We believe that assumption is well grounded. So even though listed property is cheap, we do think it's an area of the market that will continue to struggle going forward. And then another popular question is oil. We can never skip oil. The price of a barrel of oil has declined so sharply and so quickly recently.
Luigi, can on just quickly on this oil thing, but before I get there, viewers, I'm just reading some of the questions on our polls now, and just an update for everybody. We're running a series of polling questions. You'll find it on the right-hand side of your control panel. The first question we asked is around moving to level 3. So the question is, as a country, do we think we should move to level 3? The options are yes, please, open the economy. Alternatively, no, we should go back to level 5. The last option is it doesn't matter anymore. Overwhelmingly, at 95%, our viewers are saying, yes, please, open the economy. 2% are saying no, we need to pull it back and go back to level 5. And then about 4% are saying it doesn't matter anymore. And that is changing constantly. Luigi's back on this oil price thing. So, I mean, it's scary how listed property prices has literally fallen from a cliff. But on oil and the price of oil, I struggle to make sense of what has happened. I've got 14 years experience in financial services. I'm a CFP professional. But what actually happened? These prices going negative. What does it mean, and what's the forecast for oil prices going forward?
Yeah, exactly. How interesting was that? I remember the Sunday evening sitting and getting notifications about oil prices going into negative and thinking, what is going on? I can give a very long, detailed explanation, but that will take a while. So I'll try to give a more simplified explanation of what happened. So effectively, in the US in particular, oil is bought in advance of delivery. So that means that you promise now to pay at the time that the oil is expected to be delivered. And what happened though is that due to the lack of demand, because everyone was in lockdown and no one was using the oil, there was no more place to store the oil. So those that promised to pay no longer wanted the oil, as they had no place to store it. It was very expensive to store, and they couldn't find anywhere to store the oil. They therefore paid other people or buyers to take the oil, resulting in the effective negative price of the oil. So quite a weird scenario that played in. Part of the reason was also that it mainly happened in this place. It's called Cushing, Oklahoma. It's a landlocked area in the US, and transportation of oil from that place was very difficult. So it would have been very expensive to move the oil from there.
Okay, thanks for that, Luigi. I'm still not sure I understand exactly what happened, but granted, we will accept that oil prices went negative. Nevertheless, early on you made reference to three recovery scenarios. Specifically, you made reference to a V, a U, or a L-shaped recovery.
Mm-hmm.
What does that mean, and what can we expect under each of those scenarios?
Yes, Marlon, those are the three main scenarios. Of course, there could be others as well, but we think these are kind of the main ways that you can think about the way that GDP growth could possibly recover. Yes, and I did speak about that, but this table, as you can see on the chart now, on the presentation now, shows it more clearly. So a V-shaped recovery is a quick correction and would result in strong equity returns. And you can see the forecast in the table says that the equity market could increase by more than 40% if we see the strong recovery. And that's also, reliant on the pandemic being contained and things kind of returning back to normal very quickly. A U-shaped recovery is more drawn-out recovery and possibly result in mediocre equity returns. So our forecasted levels are between -10 and +10% returns. And an L-shaped recovery is if the pandemic is not contained and we see new waves of infections after lockdown, which continues basically until a vaccine is found. This results in sharp declines in equity prices, and that could mean -40% equity returns from the point we see now. And you'll see in the table that we assign the greatest probability to the U-shaped recovery. It says tentative probability, it says 50% there, but we must be conscious of the other scenarios as well. And so that's how we think when we build the portfolios. We need to build portfolios that can deliver an appropriate risk-return profile regardless of how things turn out. This is the main reason why we've included bonds as a maximum overweight in our portfolios. The yields available on bonds increase to above 10 and 12% in some cases, depending on the maturity of the bonds. And that can be locked in for a number of years and is guaranteed by the SA government. It still has some volatility, but would outperform equities in any mild or protracted recovery. And this is certainly an asset class that provides opportunity to investors. So to sum up the year so far, this table divides the period from the largest of the drawdowns towards the end of March and until the middle of April, the pink part of the chart and the green part of the chart. The table shows the negative impact of the lockdown in February and March and the sharp partial recovery to the middle of April. This has happened both globally and in South Africa. So in the top half, you can see some global indices, and in the bottom half, you see some South African categories that we invest in. And it implies that markets have looked through the negative effects so far and have started to price in an economic recovery. Our well-diversified funds have been resilient as markets struggled, and we've participated in the recovery so far. But we maintain a more cautious approach as the outcome of the pandemic remains uncertain. There is no doubt that valuations are compelling in certain asset classes, and enough risky assets are employed in our funds to benefit from when the market eventually turns up quite strongly. So Marlon, I'll sum up quickly what we've spoken about by three main points. The market sell-off reflects significant uncertainty. PPS portfolios have been resilient and select asset classes offer significant compensation for risks. And the impact of the pandemic will eventually pass. So investors must stay committed to their long-term goals. Thank you.
Okay, Luigi, thank you for those insights. think it's definitely uncharted territory that we in. Some commentators, as you so rightly pointed at, have likened the volatility and specifically the impact on GDPs locally, both locally and abroad, to an event which has a similar impact to the magnitude of what we experienced under the Great Depression. So very quickly, back to our polls. The latest figures right now is I'm looking at our audience, and about 87% of our audience is in agreement still. That number has fallen. That yes, we need to move to level 3. And I reckon I must stop talking about that now, because the more I talk about the 87% at least, the more it falls. It temporarily dropped to 86%. It's back to 87%. 8% of our audience believe that we're playing with fire. We need to go back to level 5. While 4% are still indifferent. 4% believes it really doesn't matter. It's too late. We're going to be finding a new poll within the next few minutes. And whilst we're doing that, let's just back to our risk-adjusted strategy that our president announced. I think many industries have been impacted. Professionals in particular have really been impacted. We rely largely on face-to-face consultations with our clients. And I think it's the same for PPS. It's for all intents and purposes, face-to-face engagements are illegal possibly until level 2, if not up until level 1. And as a result, businesses have been forced to find different ways to work. Personally, for me, I think it's awesome. I love working from home. I'm super productive. And I think for PPS, not just PPS, but for all companies, investments in new technologies has made it possible for us to continue with our business without the need for having face-to-face engagements. So Natalie, turning to you now. PPS's investment in fintech started way before the pandemic hit us. Please tell us a bit about the tools available which enables our members and our intermediaries to engage digitally with us.
Thank you, Marlon. Before we start to look at what PPSI has available for you to engage digitally with us, I thought I'd start by sharing what apps are getting all the hits these days, actually. And not surprising, everybody is online, and apps like House Party and Netflix are leading the bunch. And Instacart in the US has actually seen an increase of 650% in new users between March and April. That's a whole lot of new online shoppers. Now, in South Africa, we're pretty limited as to what we can buy online during lockdown. So we looked at what people are buying online in the UK. And we all know there are some recent cries to open up our e-commerce with no restrictions in South Africa. And we think we'd potentially be buying the same things. So what are we buying? Well, me personally, when I heard about the lockdown, the day before lockdown, I rushed to Sportsman's Warehouse to get myself a skip rope. So the exercise equipment resonates with me a little bit. But I suppose with the winter clothing items being an essential item during this lockdown, it's interesting to note that the best lockdown brands have been the Uggs and the Crocs. So it makes you think, is the perfect combination for winter an Ugg Croc? Who wouldn't want that, right? Well, at PPS Investments, we have developed our digital engagement platforms to ensure that you actually get what you want. So, Marlon, as you rightly pointed out, PPS investment into fintech started way before this pandemic hit us. And digital servicing has been a core focus of PPS investment service offering since its inception in 2007. So with a secure site online and a self-service app for clients, PPS was at the head of this digital pack. And over the years, PPS has built on this advantage and now offers a multi-channel approach. But not only have we invested in our client-facing technologies, but also in technologies that are used by our clients. And in 2019, actually, we upgraded our call center software, which allowed our staff the ability to service our members from anywhere at any time and via a member's preferred channel of engaging with us, which includes web chat. And what this also meant was when the pandemic struck, we could mobilize our client services team immediately to work from home. without interrupting any services to our members at all. And during this time, our call, email, and digital servicing channels remain fully operational. And we encourage you to utilize our digital servicing channels, such as SecureSight and PPS Horizon, and our self-service app, which is available on all smart devices, to monitor and manage your investments securely online, anytime, from anywhere. Thanks, Marlon.
Natalie, I'm not so sure about Agrox.
Yeah.
What I am sure about is that investment planning it's fairly complicated. It can be quite risky. It's a specialist field in financial planning, especially if you get it wrong. And it's for this reason that many of our members they would rather not do it without the assistance of a professional. Fortunately, Horizon has been designed for advisor-assisted transacting. So what this means is that financial advisors are able to remotely guide our members through any transaction. And because it's online, our members can now buy investments anytime, anywhere. So viewers, we are busy running at the time, quickly reaching the 40-minute mark. I want to keep us on track. So at this point, I'm going to turn to Haley, but just before I turn to Haley, viewers, please note that we've updated our polls. The next question is, are you a PPS member? It's pretty much a 50-50 split as we speak. PPS membership is sitting at 51%. Oh, it's 50-50 exactly. Please have a look at it. Haley, back to you. So why PPS? Specifically, what to the graduate professionals?
Hi, Marlon. No, thanks so much for the question. And I think, yeah, that PPS is, investors have a wide range of options available to them, and PPS is one of them. And I think many people, members and investors alike, they know PPS as an insurance or a life company. But I think what's important to note is that we offer investments as well. So as you have mentioned, and I think we've got about 42% of PPS members on the webinar today, PPS is a mutual, which means we have no shareholders but members, and about 150,000 of those, to be exact, of which 40% are sitting on today. And they have products in one or more of the businesses at PPS. So these members, they have products that are eligible to earn a portion of the profits that PPS generates. So cumulatively of the past 10 years, we've allocated around 27.5 billion to our members. And I think that's very impressive. So as you can see from the PPS member question, a question we always get from investors that aren't members, and they always ask, can we still invest with you? So if you are not a member, you are also able to invest on the PPS Investments platform. So what we'll be looking at are some of the solutions that these investors and members can benefit from later on. As Luigi highlighted, investors may find it difficult to remain focused on their long-term financial goals, especially during these times. And part of remaining focused is looking at ways to protect your investments. PPS offers a range of solutions that can help you focus on your financial needs and goals. And through our platform, investors have access to a wide range of funds, and these are all on a competitive sliding scale. A very exciting solution or product that we've recently launched is our PPS Investments Family Network. I'm going to show you a short video, which I think will explain it quite nicely.
Families are created, but wealth is built. At PPS Investments, we believe that building family wealth is the first step to creating a lasting legacy. And with the new PPS Investments Family Network, you and your family could be doing just that. So, what is a family network? It's designed to reward families who invest together. By investing together with PPS Investments, you'll qualify for reduced administration fees. Create your own family network with you as the core investor, your spouse, parents, and all your children, no matter how young or old they are. Because we know that every family is unique, we cater for most modern family situations. So, while your family may be a bit complex, the benefits for your family network is simple. The more you invest as a family, the more you could save on admin fees. To get an idea of how much you and your family could save, explore the PPS Investments Family Network Play Zone. With this interactive, self-service play zone, we'll show you how easy it is to create a family network. Access the PPS Investments Family Network Play Zone via our website, pps.co.za/family network. Because success is better shared. Contact us on 0860 468 777 or at clientservices@ppsinvestments.co.za. Invest in yourself. Invest with each other. Build your family's wealth. Build your family's wealth.
So, Heidi, I think two questions slash comments from my side. Before we go there, audience, you'll see on the right-hand side of your screen at the user panel, there's an icon called Office. So if there are any of you in the audience right now that wants to learn more, you'll see the Office. Currently, there's an offer with a link to all of our products within PPS, the main PPS sort of website. And then there's also a link that will take you directly to our family network page. Please have a look, those of you that are interested. So really, from my side, I've always had a philosophy which has served me very well over the years. And this philosophy basically states that, in general, price is a measure of quality. Now, when we invest, this is not always the case. Let's be honest, fees erode returns. Generally, fees are levied on a sliding scale. The larger the investment, the smaller the fees which are charged, or relatively to the size of the investment. So what we tell our audience is that they can actually combine investments with family members and then use that combined investment for a lower cost. That's my first question. And then the second one is, what is the impact on my profit share, at least, of combining investments from other family members?
Great. So exactly to your point, I think especially during these times, individuals and more importantly, investors, you're looking for solutions and you're looking what making what you have work for you. So similar to the ethos of mutuality, intergenerational wealth is very important to us. So what is great about this family network solution is that it works with the investments that you already have. It offers you the opportunity to extend the benefit of reduced admin fees to your immediate family invested on the PPS Investments platform. So the more you and your family invest with us, the more everyone in your family can benefit. So just to note that this solution is available or open to all investors, whether you're a PPS member or not. Another way that you and your family can benefit on the PPS Investments platform is through linking. So as a qualifying PPS member, you can link investments held by your children, your spouse, life partner, or parents to your PPS member number. So what means is that qualifying assets are then included and can boost your profit share allocations. As always, whenever you're looking at any of these solutions, we recommend that you speak to your financial advisor who can help incorporate all of these value-added benefits into your overall portfolio to complement your holistic financial plan.
Thanks, Hayley. Thanks not just to you, but thanks, Luigi. Thanks, Natalie. Thank you all for your insights and your contributions in today's presentation. So we're going to move forward now to our Q&A session. But Balwa is getting our questions together. So we can open up the floor to our members. Please use the not just our members, the viewers as well. You can open up the floor for your questions. I see there's a few coming in already, but before we get there, we've just launched a new poll, and the new poll would like to know: would you like to know more about the PPS family network, or PPS My Family Network at least? Currently, 55% of our audience is saying yes, they want to potentially benefit from lower fees. This through combining the investments of their kids, their parents, their spouses, etc., etc. So I'm gonna move forward now. I'm gonna move towards the Q&A session. I see there's a few questions coming in already. The first question comes from Roger Bester, and Roger wants to know whether our view is that the current valuation of the rand, is it undervalued? Luigi, will you take that one, please?
Sure. And like I alluded to, the rand is a very common question that we get. Like I said, the rand's a very difficult currency to forecast because it's so liquid, meaning that a lot of people can transact on the rand whenever they need to do that. So we tend not to try to make a forecast on the rand because of that volatility. What we do though is we look at what's called a purchasing power of parity calculation. So we look at kind of relative to other currencies in the world, where do we think, based on our inflation differential compared to those countries, where the rand should be. And what is noticeable though is that if it's a certain distance away from that parity level, we tend to see the rand moving back towards the average of that. And we experienced that when the rand went above 19 rand to the dollar. And as it has come back a bit and is being closer to 18 rand to the dollar, it's that level of being far away is not that far away anymore from that parity level. It's still a bit on the cheap side though. But if it's less than one standard deviation away from that level, the performance is actually quite random in the short term. Our view longer term though is still the inflation differential is the important question. So you have to look at what's the inflation in your economy compared to the economy that you're comparing against. And even though inflation in South Africa is relatively low by our historical levels, it's still high compared to developed market economies. So when you have higher inflation in an economy, you tend to see a depreciation over the long term for the currency. So our long-term view is definitely that the currency will still depreciate. Short term, though, we're very likely to see a lot of volatility from these points, and it's going to be very dependent on as news comes out and how that affects emerging markets or developed markets.
Okay, thanks for that, Luigi. I hope that answers your question, Roger. Our next question, I think, is a similar one. They probably linked. So either of you that are willing to take it, it's fine. Next question comes from Terence Hillhorst. Terence wants to know, what is our opinion or your opinion on offshore right now?
Okay, I'm happy to answer that. So we have a house view approach where we look at the various different asset classes that we can invest in. And global equities is one of those asset classes that we consider. So there's various considerations that we take into account: valuation, momentum, relative valuation of that asset class compared to another asset class. For example, at the moment, in our house view, we have domestic equities, so South African equities as a underweight, and we have global equities as an overweight. We believe, and I think Terence was possibly alluding to that in the question, we believe that the opportunities offshore are wider at the moment. We see, for example, these type of IT infrastructure that's required. It's very difficult to benefit from those type of things. Microsoft Teams, Zoom, and the likes of those type of IT systems is very difficult to benefit from that in South Africa. Globally, there's a lot more opportunities to benefit from that. And maybe by way of one example, we invest in a fund actually in Scotland called the Bailey Gifford Discovery Fund, and they, as the name suggests, they're actually looking for parts of the market globally where there's these discovery opportunities. So be it in IT infrastructure, be it in building electric cars, be it in healthcare technology, and that's one of the underlying fund managers that we've benefited significantly by being invested with. So in terms of offshore, we definitely think there's opportunity for offshore, but that does not mean that a client that has liabilities in Rand should have all the investments offshore. We just think relative to a specific level, you should probably be overweight your offshore allocation at the moment.
So, and I just wanted to also mention, thanks, Luigi, that we've also recently launched our PPS Global Equity Fund, and we've partnered with an international asset manager by the name of Capital Group, and we think that this manager has great construction abilities and investment capabilities to provide our members and investors with a great opportunity to get that offshore exposure. So that fund is actually a USD denominated vehicle, and we've also recently looked to launch a feeder fund of that solution as well.
Okay, awesome. Just a quick update on our poll. Currently, 60% of our audience is saying yes, they want to benefit from the family network. They want to have a look at their portfolios with a view to combine investments to pay lower fees. Moving back to our questions, the next question that I have is from Brendan. I think it's Pegram. I think that's correct. Brendan wants to know, he's heard from a couple of asset managers, their personal opinion, that they expect another dip in the markets and that we might reach the lows we had recently. What is our views? This is this famous double dip that everybody's talking about. And should investors possibly move to more conservative portfolios before this happens? He understands that it might lock in losses, but it may also provide them with some good growth should they move back to more aggressive portfolios once again have reached the bottom. So before any of you take that, I mean, I know that there have been numerous studies done. We had thousands and thousands and thousands of studies. There's empirical evidence that states that timing the market doesn't work. What is more important is time invested in the market. So from our panel, Natalie, Haley, Luigi, is it a safe move? Would it make sense to move to more conservative type funds, given that there's this real risk of a double dip, or should we remain invested? What are your thoughts?
So I mean, this is kind of what we do on a daily basis. We look at how funds, are invested, and we have a very good idea of the risk profile of the investor in each of our risk profile funds. So we would say that we take that responsibility on board to ensure that the risk profile of that particular fund remains appropriate for that investor. So we would say it's not necessary to do that, not necessary to change what you perceive to be your risk profile changing at any particular time. What we have done, and what I alluded to earlier, is that we have taken a slightly more conservative view across our portfolios, and that talks to the probabilities that we've assigned to the various shapes of recoveries, the V shape versus the U and versus the L. So we place a greater probability on a U-shaped recovery, but that does not mean that we must totally disregard any other scenario playing out as well. And we need to build portfolios that can be robust regardless of the way that markets turn out. So we need to have enough risky assets regardless or in all portfolios, so that if the V-shaped recovery does come about, we can participate somewhat in that recovery as well. At the same time, if markets don't turn out well and we have this double dip scenario playing out, we need to have enough cautious assets in the portfolio in order to make sure that we don't participate fully in the downturn in markets. And that's what we grapple with, and that's what we try to do for clients on a daily basis.
I totally agree. I think during a time like this, what is more important is what your long-term objective is. I remember the slide you brought up, Luigi. Now, audience will remember too the slide that showed volatility and returns over the long term. I think you were tracking um, um, share performance since I think the 60s. And at any given period, you'd find there's extreme volatility over the medium sort of term. The important, I think more importantly, is the trajectory of prices over time, over the long term. So I think my advice to members would be that we don't change portfolios until there are material changes to the assumptions that we used in the initial construction of that portfolio. So the assumptions that I make reference to, let's do it by way of an example. If a moderately aggressive portfolio was constructed for me because my kids have got to go to school in 15 or 18 years time for some kind of like an education fund or whatever the case may be, and there's no material change to that term, it's still 15 years, and the prices of those courses don't vary wildly, then there's absolutely no reason for me to change the makeup or the asset allocation within that fund over the short term. If, however, there is a change to assumption, so a change to assumption could be something like school fee prices shoot through the roof or they fall significantly. This has a material impact on my planning. And because of that, I could possibly have to change the asset allocation within the portfolio that has been constructed. Another quick one, I see I've got a question from Tami Bokwa. And Tami wants to know, I think the family network seems like it's been quite a hit. Tami wants to know, is there any way that PPSI could use the same concept but expand it to other types of investments? Now, I'm cognizant of the fact that we've got the limitation of eligibility with specific regard to us targeting primarily graduate professionals. So maybe, Hayley, maybe you can pick this one up for us, please. Is there a possibility that we can expand the family network concept to other investments? The one that popped up in particular, specifically from Tami, was a question around stokvels. How do we take investments, add them together, and use? Is it possible for us to use similar concepts in other types of investments?
No, I definitely think it's an option that people are looking at, and it's interesting because if you look at how PPS started, it was on the concept of mutuality. So it was dentists at least, that it was during, I think, Second World War, that they came together and almost pooled a group of their money together, because they knew that if somebody was going off to war, that they wouldn't have funds to look after themselves, look after their families. So the concept of the family network is actually sort of also happening on a mutual basis within PPS. So what you've got criteria to meet a membership. So or to be qualified as a member, so you would need to obviously look at whether you've got a 4-year degree and certain qualifying criteria, which you can reference or have a look at our website, which will give you more details on that. And then you would need to purchase one of the qualifying products. And I think there's 4 products that qualify in order to get profit share. So specifically around family networks, I think the important factor is anyone that puts money on the PPS investments portfolio or platform at least will qualify for family networks. So whether you're a member or not, if you have your money on the PPS investments platform, you can still pull the money together and be able to benefit from the admin fees. And if you are a member, if you have qualifying products, you would then be able to earn profit share on those solutions. So I think if somebody were to look at the holistic PPS solution set and make use of our different options that are available, I think you can really see the benefits from your financial planning point of view and from sort of money back in your pocket, so to speak.
Elia, I think that's awesome news. Honestly, I work for PPS, and I didn't know that we could make use of the family network. Whether or not, you don't have to be a member in order to take advantage. You could do it on viewers, what we call the open investment sort of platform. So the open platform we use for members, or at least for clients who are not members. Of course, the downside when you are not a member is that you do not share. You're not an owner of our company, so you don't share in profits. Guys, we've run out of time. I'm just cognizant of time. I'm going to wrap things up quickly. Just a quick update on our poll. It's an overwhelming 62% of our viewers would like to hear more about our family network. So just before I close, we're going to be sending off a short survey. Shouldn't take you longer than 2-3 minutes to complete. Please do complete it. We absolutely do need it. We take your feedback and we incorporate it into the planning for our next session. So please complete it. Our viewers that are interested in learning more about the family network, there is going to be a drop down which is going to ask you whether or not you're interested in learning more about it. If you are, please just select yes, and if you're not, of course, select no. So I think we have to close. So thank you PPSI, thank you my colleagues, thank you Mailing Guardian, thank you audience. A special thank you to our members that signed in today. Thank you for your continued support. Know that we're here to help you and to guide you through the uncharted territories that we find ourselves in. So I think in closing, I want to summarize the session as follows. So I think it's clear that investment markets are in turmoil. Still, in the midst of this crisis, there are opportunities. And now, more than ever before, it's critical that your portfolio is well diversified. It must be well diversified to ensure that you get the best risk-adjusted returns. It's not just about upside. It's also about providing protection when things, not should things, and they do go down sometimes, but when markets sell, we need protection. Then we also need to ensure that we remain invested. Panic selling is going to do more harm than good. We have to focus on long-term goals and not on the short-term volatility, because markets will recover. They always do. We've got history. We've seen the charts today. We've seen a long drawn-out picture from the early 20s, or at least from the 20s, all the way through to our current day. And investments in technology has made it possible that we can still do business. We can still communicate. We can still transact. Have a look at Horizon. Make sure you speak to your intermediary. He can walk you through a full analysis. So literally, you could run through the full process, conduct a full analysis, all the way from start to finish, and you could actually conclude a transaction end to end on the tool. And then, of course, I think lastly, importantly, fees kill returns. High fees erode your investment returns. Offers such as the family network are awesome. Make sure that you claim that opportunity. Make sure that by claiming that opportunity, you can ensure that you claim most of those returns actually for yourself and not just pay it away. Thank you all once again for joining us today. Look out for the next webinar banner. We're probably I think we're going to be flighting it within the next day or two. The next session is entitled Small Business Big Risk. And I'm going to be joined by two specialists, Tiffany Ann Bush, who is our CFO at PPS Group, and Tracy Linnell, who's Director of Morgan Solis. And Morgan Solis are a specialist disaster recovery and business continuity firm. Stay safe, be blessed, and see you all next time. Thank you.
Thank you.